Welcome back to our pre-budget special, What the World Wants from India. Our guest is Brian Jacobsen, Senior Investment Strategist of Wells Fargo, someone who has actually watched developed and emerging markets, and India too, for quite a while now. Brian, thank you very much for joining us. Well, first up, what does 2019 hold for equities? Since many central banks are going to be cutting their balance sheets.
That's correct. Yes, that is one of the major concerns, I think, of investors is what is the path of central bank policy for 2019. At the moment, it looks like investors are effectively pricing in central bankers being on hold for 2019. In the United States, for the Federal Reserve, federal funds futures contracts are actually saying that the Fed might cut rates towards the end of 2019 or the beginning of 2020. My team, on the multi-asset solutions team, we actually believe that's a little bit too pessimistic. A lot of central bankers still want to continue to normalize policy. Even if it doesn't mean hiking rates, it could mean shrinking their balance sheets. And that could sop up a little bit of the liquidity that has provided support to the financial markets over the last few years. So our big theme for 2019 is that you should watch and wait and be prepared for a roller coaster ride.
Okay. In that case, what's your view of global growth, especially because growth in US and China, the first and the second largest economies of the world, appear to be slowing?
Yes, U.S. and China growth, I think, is on the top of a lot of investors' mind. We know that in the United States, 2018 had about 3.5% GDP growth. In China, growth was around 6.6%. 2019 is going to be a step lower for both countries, but how much of a step lower is the big question. From our view, we think that people are a little bit too pessimistic about the growth outlook. According to a lot of the consensus surveys that we look at, U.S. growth, according to the consensus, might only be 2%. We think it could actually be closer to 2.5% to 2.75%. In China, the consensus seems to be calling for a step down to around 6% growth. We think that it could be closer to about 6.3% to 6.4%. So on the margin, we think that the market is pricing in a little bit too much pessimism. And as a result, we still continue to favor having exposure to equities and high-yield fixed income to really capture that growth premium that you get from those two asset classes.
Fair point. Okay, let me come to emerging markets, which is where our interest is. Within emerging markets, what would your pecking order be in terms of countries?
Yeah, I think our favorite area right now is in Latin America and in China. We do like broadly Asian emerging markets. That's probably our first preference is Asia EM, followed up by Latin America. Latin America, you have Brazil. That's been on a tear as far as just performing very well since the election of Bolsonaro as the president. So maybe a little bit, it's gone a little bit too fast here, and so there's more upside potential to Asian EM. Within Asian EM, our favorite is, I believe, China, mainly because people have been so focused on China and its relationship with the United States. They had a major sell-off in 2018. Valuations to us are very compelling. We think that the growth outlook is a lot more favorable than what's currently priced into equity markets.
Well, I don't see India in your pecking order. Why is that? Is it because we're heading into general elections?
Yeah, I think that is one of the reasons why India is not at the top of our list for 2019. It's probably at the top of our list for the long term if you are thinking about investing over the next 10 years. But if you're thinking about investing over the next 10 months, there's a lot of uncertainty as to how the spring general elections will play out. One of our big concerns is about the policy outlook for India, both on the monetary policy and on the fiscal policy side. When Modi was elected, everybody viewed him as a reformer, and he has indeed brought about some reforms. But his party hasn't fared very well in some of the regional elections. We don't think that he's made a lot of progress on some of the reforms that he had pledged to make. It seems like he has pivoted a little bit more towards some maybe more populist policies that don't necessarily encourage private sector activity. It's more focused on giving out certain goodies to constituencies. On the monetary policy side, we're a little concerned about the change in leadership. We really need to know how this new governor of the Reserve Bank of India is going to behave. Patel, he seemed very hawkish, which was a plus, but mainly a minus as far as with growth. He was very focused on inflation. But maybe the pendulum has swung a little bit too far the other direction, where the new head might be a little bit too dovish. So we really have to feel him out to see what sort of policies he'll put into place before we can get a good read on what the outlook is. Okay.
Well, I do want more color on what you think about fiscal policy and monetary policy. First, fiscal, there is an interim budget due on Feb 1st. There is a fear that a big farm relief package could come in. What are your fears and expectations?
Sure. Yeah, we do pay attention to the budgets, and that's one of our concerns actually about investing in India and across a lot of emerging markets is the focus tends to be a little bit too much on what are these budgets. We would rather focus on the fundamentals of the businesses that you can invest in and not necessarily have the future, whether it's over the next 12 months or the next few years, be so heavily dictated by swings in the budget. Does it include farm relief? Does it include infrastructure spending? Does it include tax cuts? What are they going to do about the banking system? So there's a little bit too much policy risk with this fixation on the budget. Now, broadly speaking, for India, I think that a lot of people are looking for them to continue with opening up their markets as far as to competition, with trade policy, balancing the budget. We don't expect that they'll have a balanced budget, but at least to get the deficit under control. My guess is that with the interim budget, we'll probably see a little bit more deficit spending. And that could be slightly negative, at least as far as with way foreign investors view yields and investment opportunities in India. And it might actually be somewhat detrimental to the rupee outlook as far as on a foreign currency. The currency has depreciated pretty significantly since October, and if they have too high of a deficit, the rupee could come under additional pressure.
You know, the other worry is that the budget could announce a large package farm spending program and still kind of appear to meet the deficit, and it could be therefore followed by a dovish monetary policy. How would you receive it if there was a dovish policy and a rate cut after such a budget?
From our perspective, that would be a bad combination. If you had a larger budget deficit and then if you actually had monetary easing following that, the perception would be that monetary policy has become beholden to fiscal policy, which can actually be a very negative thing, especially in the emerging markets. If it's viewed that the Monetary Policy Authority is effectively monetizing the debt or the deficit spending, that tends to be a formula for faster inflation in the future. And so that would, we think, be quite a negative.
Okay. Now let me come to brass tacks. What are you invested in, and what would you want to add on? First of all, would you wait before you made incremental investments?
Yeah, so across our portfolios, a lot of them are very well diversified, and so they do have some exposure. A lot of the exporters in India, if you think about some of the information technology companies, especially, a lot of their sales come from outside of India. And so they've actually, with the depreciation of the rupee, are in a slightly better competitive position. So we are very selectively investing there, but we are not overweight in India like we had been in the past. So it's now more of an underweight position. And in order to get us to go overweight to India, I think we would want to see a little bit more fiscal discipline and monetary policy discipline as well.
Okay, that's very well put. Ahead of two big events, the monetary policy on Feb 7th and the budget on Feb 1st. Brian Jacobsen, thank you very much for joining us with your perspective.
My pleasure. Thank you so much.
Okay, well, so the key takeaway here is that the foreign investors would like to see fiscal discipline and monetary discipline. The Reserve Bank needs to ensure that its credibility is maintained. We take a break on that note, but don't go away. The man who coined the term BRICS is our next guest. Jim O'Neill, former chairman of Goldman Sachs AMC.